everyone, and welcome to the conference. I had a discussion about this meeting more than a year ago with Dr. Cockerell. It was his idea then that it was really essential for young physicians to learn more about what is going on the business side because of his past experiences. Because I trained in pharmacy school first and was part of a corporate training program to run a pharmacy, I was fortunate to have had some background, chiefly in accounting and finance, when I was finished with my dermatology residency, but I was still ill prepared for what was to come. So based on my own experience, I was really in complete agreement with him. More recently, as I was finishing my MBA at University of Texas, he asked me to present what I thought were some of the best lessons from that training. So that is what I'm going to introduce you to in our short time here today. I have to apply a disclaimer. This session information shall not be understood to be construed as personal financial advice. I am not an accountant or an attorney or financial advisor, nor am I holding myself out to be. And the information discussed is not a substitute for financial advice from a professional who is aware of the facts of your individual situation. That being said, let's get started. When it comes to finance, there are core essentials that you must learn about both in your personal finances and business finances. You must consider why you are working aside from your personal mission as a physician. What is your goal? In its most basic form, you want to be able to provide for your family now and in the future and be able to provide for yourself if you are no longer able to work. None of us knows for certain when that time will be, and it can arrive quite without warning. The strain of that process is emotional as well as financial, so it's in your interest to do what you can well in advance to ease the burden on yourself and your loved ones. So personal finance revolves around what you bring in, how much you save and how much you spend, and how you invest, which includes but it's not limited to your 401k or 403b type of retirement accounts. In business, it's about risk and return, cash flow, and what's called the time value of money, because it impacts both business and personal. We will discuss the time value of money and why it's important, and then we will talk about the power of compound interest and how it can be used against you, but also how you can lever it for your benefit. Remember, there are many, many folks out there who are intimately familiar with these concepts that are trying to separate you from your money. First, let's start with some basic definitions so that we are all talking the same language. Accounting is a system to provide reports on financial position and performance. The system has many rules, and you should learn some essentials. For instance, double entry bookkeeping in accounting is the basis by which all modern business has been made possible because it's designed for accuracy and helps to detect fraud. Finance is the process of channeling various funds in the form of credit, loans, and invested capital to those economic entities that most need them or can put them to productive use. On the personal finance side, it refers to the management of your money and includes activities such as investing or budgeting or saving. Economics, which I have a particular liking for, is a study of supply, demand, costs, prices, and scarcity. When we apply it to business, it becomes business economics, though my interest is in behavioral economics, which is where psychology meets economics. My interest is there because it's particularly relevant to medical economics. So what is money? Money is a medium of exchange for goods and services or as a repayment for debt. Money is intangible. Currency is the bills and coins you have, the physical form of money. So money in an account exists, but it's not really physical money. Here's a little factoid for you. Legal tender, which is printed on bills, is not the same definition. Legal tender is money that, if tendered by someone that owes a debt to someone else for that monetary obligation, may not be refused by the creditor. So a check is not legal tender. You do not have to accept it as payment. A check is a draft, that's the term, that directs a bank to pay a specific sum of money to the bearer of the check. The check has no value by itself. Cash is cash or cash equivalents that's held to be used to acquire assets or held for that purpose to generate a return for the firm or the company. It's not a term that's used commonly in personal finance. Debt is money owed. Many of you have school loans, so I think you understand what the word debt means. Profit is what is left when all the costs of the event have been accounted for. So whatever you're doing in business, once you've accounted for everything that's involved in that, what's left is termed profit. We can break profit down to different types, but for you, you think of net profit, which is the final number. Assets are what we use capital to acquire. They have a value which can fluctuate. Hard assets can lose value all the time. That's called depreciation. Some assets can appreciate, like real estate or pieces of art or even some types of wine. You may be shocked to know this, but while you may consider yourself an asset to your program or your company, U.S. accepted accounting principles consider you an expense and a liability. Many view their staff as an asset. I certainly do, but you don't own them, and therefore, according to the definition, they are not assets. Liabilities, on the other hand, are legal debts owed to third parties like governments for taxes or employees for payroll or utilities for water and electricity, in addition to loans and bonds and other forms of debt. What is interest? Interest is the cost of money. Inherent in that cost, depending on the situation you're talking about, is risk. The higher the risk, the higher the interest. You understand that if you have a credit card purchase for an item you bought that was $500 and you don't pay your balance within the grace period, that item is now going to cost you $500 plus an interest payment of about $15 a month. In 2022, Americans paid $164 billion in interest and fees, so interest is very big business. What is inflation? Inflation is a very important number, as you will see. If you go to the grocery store and a ribeye is $30, when pre-COVID it was $15, that is inflation. You will now not be able to buy something else if your income has not matched the rate of inflation. Equity is a very important term. You will hear this a lot from people wanting to lend you money for a house about building equity. When you buy stock in a company, you are buying equity. And if you listen to CNN or CNBC, you will hear them refer to stocks as equities. What does that mean when you have equity, or you're buying equity or building equity? That means you have a claim on residual value. So if the company runs up a lot of debt and the business fails, your residual claim is zero and you get nothing for your stock. Your stock is only worth what someone else will pay for it. Same with your home. As you'll see in an example coming up, the equity you build is the value that someone will pay after you've paid off any debt. Residual value, remember the term residual. So let's look quickly at the accounting equation, what's called the accounting equation: assets equals liabilities plus owner's equity. This, like death and taxes and gravity and a few other things, is certain. It does not change. Here we have a case of a house that you buy for $450,000. You borrow $400,000 and you pay $50,000 down. If you sell it tomorrow, your equity is your residual value. It's what's left after you repay the loan. The lender gets paid first. If you sell for less than you bought it, you're going to eat the loss. It's going to come out of your $50,000 in residual value, your $50,000 in equity. In this case, our asset is the home, as we defined it earlier, that item that provides you a future benefit. That value presumes that another party would pay you that amount. Your liability is the debt, the loan on the home, the obligation to repay. What's left in this case is your $50,000 in owner's equity, the residual value of the debt paid. When a broker tries to convince you that you are building equity, this is what he's referring to. We will come back to this example shortly. Now, there will not be a test on this slide, of course, but you can see that in business we get a lot farther in depth. Here you can see what qualifies as assets, long-term or non-current assets, those resources with an economic value that an individual or a corporation or country owns or controls with the expectation that it will provide a future benefit. That's the definition of assets. Your current assets are listed in order of liquidity, meaning how quick you can turn them into cash. And then there's intangibles that were acquired, liabilities, remember those are obligations, some short-term and some long-term, and equity in its various forms. Just know that whether you're doing your personal finances or business finances, the rule holds. Of these, the most important to remember is that equity is a residual claim on assets. As I said, we will revisit this again in a few slides. So, a few more definitions. A stock is a share in the ownership of a company, meaning you have a vote and you have an equity claim on assets. Understand that this means you could lose money if the company's liabilities exceed its assets. Now we're back to the the inevitable accounting equation. If you do not have any insights into the finances you're investing in, do not do it. Understand the business you're investing in if you're going to invest. The primary difference between bonds and a loan is that bonds are the debt instruments raised by a company for raising funds, and these bonds are tradable in the market, chiefly in little portions of a bigger entity, a bigger bond. So the person can sell it without having to wait for the individual bond to reach maturity, where a loan is an agreement between two parties where one person borrows the money from another, and they are generally not tradable in the market. Depreciation allows you to deduct the cost of a tangible asset over time. A tangible asset is something you can hold, a building, an automobile, a piece of equipment or technology. Amortization allows for the deduction of costs over time over an intangible asset, for instance, and you would have to purchase these to be able to do this, but a trademark or a patent or a copyright or other piece of intellectual property. Just understand that bondholders get paid first over stockholders because a bond is a legal obligation to repay. Stockholders get what's left, if anything. Liquidity, as I mentioned earlier, that is cash or cash equivalents that can be quickly converted to cash for immediate needs of the business, or even in your personal finance. How much liquidity is how much cash you have around or can get your hands on quickly. Collateral is what lenders demand from you to mitigate their risk. It's something of value that can be seized if you default. So on our example, that would be the house. They like a big piece of property because they can take it from you and resell it to get their money back if you don't pay. And people that lend money are characteristically risk averse. They understand that there's a possibility they might not get paid back. And so that if you borrow where there's no collateral involved, they're going to charge you more money. The interest rate's going to be higher. So that reflects what we talked about earlier when we said the higher the risk, the higher the interest. So for instance, the interest on a school loan, since you didn't put up any collateral, is higher. The interest on a credit card, where you're not putting up any collateral, is higher. There are mechanisms to help you with that. So if you're going to open a small business like a medical practice, the Small Business Association will guarantee small business loans to help bring that interest rate down. First-time home buyers can get the same thing, but when you sign up for the first-time home buyers program, they do charge you an additional fee to cover that extra risk cost. Revenue is money generated from sales. Income refers to revenue minus expenses, so income and revenue are not the same term. So time value of money. The time value of money is a term I never heard much about, although it's always been out there, but it came up repeatedly during my MBA training program. Your dollar will not be worth tomorrow or next year what it is today. When we were kids, we loved to play pinball, but we thought that 25 cents was really expensive. If we went through $2 playing pinball, that was a lot of money. Your thoughts about the same $2 right now are that $2 is really a small number. That's time value of money. If you have a child, you should not teach them to use a piggy bank. By the time they take their money out of the piggy bank, it won't be worth very much. Teach them to save smartly and put that money to use so that loss does not happen. You can see what's happened to the purchasing power of the dollar over time. This is the result of inflation. You can see how in 1973, inflation doubled to almost 9%, and by 1980 it was 14%. That was a really bad time in my family, so I remember it. Inflation has been muted as a result of Federal Reserve Bank policies for the last 10 years before COVID, but it has recently shot up in 2021. This is a graphic of the decline in buying power at various rates, the time value of money. On the other hand, the power of compound interest demonstrates how you can invest or save and reinvest and use it to your advantage. You want to be on the receiving end of the compound interest graph, not the other way around. Of course, we have equations for determining the future value of money based on the interest rate and the number of periods over which the rate is applied. No one expects you to memorize these, but you should know that these are in use multiple times a day by people that do finance and in some respects accounting. Here you can see a simple example of a 1-year period, a present value of $10,000, and a 10% interest rate. So after 1 year at 10%, your sum is now $11,000. You can see here that the equation for determining the final value for compound interest is the same as the equation for the future value of money. What should you take from this? If business is using this formula, then you should be using this formula. And you don't even really have to memorize the formula. There are plenty of websites that you can go to and find a compound interest calculator and easily put values in and find these numbers for yourself. Although this can be entered into an Excel sheet and you can quickly determine these numbers. So it wouldn't be a full discussion without a little algebra here where we rearrange the terms a little bit, in which case we can now calculate the present value of money from the future value of money. So in this example, we have $5,000 at 1 year from now at 7%. What does that mean? It means that to have $5,000 in a year, we would have to invest $4,673 at 7%. This is used every day to price bonds, which have 2 interest rates, as well as valuations in stocks and companies and many other things in business finance. So keep in mind this concept that your dollar today will not be worth a dollar tomorrow, and what that is going to mean for you when you retire or sooner when you like to pay for college for your kids or to buy a bigger house. These two guys, Albert Einstein and Warren Buffett, are famous, of course. Einstein, the math genius, didn't miss it. He called compound interest the 8th wonder of the world. Warren Buffett, among the most famous investors of all time, came along much later and had the same conclusion. So let's see what it is that they're talking about. So when you're talking about annual interest rates, by the way, pay attention to the APY, which is the annual percentage yield, not the APR, which is the annual percentage rate. The APY is the yield, the larger of the two numbers. What you'll notice now on your path to financial mastery is that businesses who want to loan you money will use the APR, like credit card companies or mortgage brokers, because that's the smaller number. If they want you to deposit, they will emphasize the APY, which is the bigger number. The difference comes in the compounding, as you will see here. The more frequently you compound, that added amount starts to earn interest and the faster your money grows. Here we see a 1-year example of $10,000 on the left and a graphic display of $1,000 over many years on the right. It's an exponential curve, meaning the slope is increasing. Now, let's return to your home purchase from the previous example. Understand in advance that this guideline breaks a rule that you should never put less than 30% down on a home, but it illustrates why that is. Here you can see that over 30 years, you will pay $558,036 in interest. Notice the lines. Because of how loan interest is amortized, you will be paying interest in large amounts for most of the life of the loan, and not even getting back to half of the principal value for more than 20 years into the loan. Look at the light blue line, that is principal paid. This is the power of compound interest working against you. So in this instance, I made a modification to the terms. Here we can see the effect of a payment of an extra $1,000 a month on the numbers. Your interest is cut by over 57%. This effect is due to the extra payment, the extra $1,000, being applied to and reducing your principal on the loan at a much faster rate. Another little tip for you, if you were going to make an extra payment, you have to mark on the check balance to principal, or they will take your extra payment and apply it directly to interest. In addition, you are now going to be paying off this home 16 years earlier. So what is the outcome of this scenario? Remember, your equity is your residual claim on the assets after all the liabilities have been met. But there are other liabilities besides the interest rate, like insurance and property taxes, which we will estimate for illustration. But we have others like utilities and HOA fees that we've left out. Additional costs like repairs are not included here. We have our original accounting equation, And just below, I have entered the future value formula for the home into Excel. Remember, the home price was $450,000. Your loan was $400,000. So the future value of the home is projected using the original market value of $450,000. The future value forecast for the home in 30 years at the pre-COVID historical average annual property appreciation rate of 4% is $1,459,000. Your interest is not your only liability. So if we add the principal that you borrowed, the interest, and the other liabilities, you paid out almost $1.3 million. What did you gain? Your gain would be $171,492. The present values for that amount are seen here. The Excel formula for present value is there. You can see it. The red area refers to the interest rate in each cell as it moves across. So what I've done is taken that amount, the $171,000, and brought it back to the present value based on different rates of inflation that you can see in the boxes. So at inflation rate of 3%, your $171,492 in 30 years will buy you about $71,000 worth of stuff today. And if the inflation rate between now and then is higher, then you're going to be able to buy less stuff. It illustrates how important inflation is to what you earn and to what you save. So here's a summary of the two scenarios. At the top are both formulas for future value, one that comes with Excel, and then my manual entry. They will come up with exactly the same number. It's just one is built into Excel, and the other one I have put in there for demonstration purposes to come up manually. The 14-year scenario is highlighted in green as that was the year that the loan was fully paid off in our extra payment scenario. Look at the red arrows, principal paid. Observe how much principal you have paid with the extra payment, which is all of it at 14 years, compared to how much you paid off in the first scenario of 14 years. So much for building equity. Look carefully at the costs between the two. In the first scenario, you will have made payments for 14 years and the home appreciated in price, but you are still paying interest on more than 75% of your original principal. So let's turn it around and use it for you, not against you, and look at the power of compound interest. Here we have two people, Ben and Joey. Ben starts investing early at age 21 and invests $2,400 every year, and he stops contributing money at age 30. The total amount he contributed is $21,600. Joey starts investing at age 30 and invests $2,400 every year and contributes money until he's 67 years old, a total of 37 years. He contributes more than 4 times the amount Ben did. So what do you think the comparison is going to be between the outcomes for these two individuals? This assumes that the mutual funds that they've invested in are going to average 11% over time, which is a little bit more than the past 20-year average for the S&P 500. You can see from the graphic, and you can put this information into a compound interest calculator and generate these curves. It's Ben who started and stopped early who has benefited the most. It demonstrates that the compound interest it can be a very powerful tool for building wealth over time. And clearly this is what both Einstein and Warren Buffett referred to. If you're disciplined and both strategic and tactical in your savings and planning, you can benefit as well. This assumes, of course, that you would get an 11% return in this example, which is probably a little bit lofty, but the overall averages are not far from that. But you get the idea here of what can happen when you put the power of compound interest on your side. So we'll close out with one final sort of a real life example. Here's an entry I made to inquire about an annuity. An annuity is a contract that requires fixed payments over time. It has to be more than a year, and it's usually where you pay money to an insurance company, and in return, at some point in time, you get a steady stream of income. Some people prefer the certainty of the income in the retirement without having to be concerned with investing and managing money. So these instruments fill a certain need. In this case, it's an annuity that you would buy for $300,000 now. It would not start paying for 20 years. And when it starts paying, it would pay $3,900 a month for 20 years. So that your minimum payout, your $3,900 per month for 20 years would amount to $936,000 in return over your $300,000 that you put in today. So the question is this a good deal for the buyers? Is this a good deal for me? So let's see. So again, we are not demonizing annuities here. They come in many different sizes and shapes to fit many different needs. But like everything else, you need to be a very informed individual before you go putting your money down in one of these investment vehicles. So what I've done here is if you invest $300,000 in a municipal bond account, which generates tax-free returns, and add nothing more, in 20 years, you'll have about $667,000 in that account. Remember that with an annuity, you are going to pay tax on those gains when you start taking the payments. You don't get taxed on the principal amount, your $300,000 that you paid for the annuity, but you will get taxed on any gains. In this tax-free scenario, you will be able to draw out $3,900 a month starting in 20 years, pay no taxes, and then after 20 years, you will still have $51,000 in your account when you are done. The insurer who sold the annuity calculated their own risk, that they could invest your $300,000 over 40 years and pay you $3,900 a month and still make money. As a buyer, you offloaded the risk of doing that in exchange for certainty. What you need to really figure here is how much your $3,900 is going to buy you in 40 years when you go to use it. And so for that, you can very easily on your own pull up a present value and future value calculator and figure out the present value of $3,900. So I hope you all found that useful. Best wishes.